It's 6:47 a.m. on a Monday morning, September 15th, 2008. Your alarm hasn't gone off yet, but your phone has already buzzed 14 times. You roll over, squinting at the screen. Texts from coworkers. Missed calls from your managing director. A single message from your buddy on the derivatives desk that says, "It's over." You are a trader at Lehman Brothers, the fourth largest investment bank in the United States, a 158-year-old institution that survived the Civil War, the Great Depression, 2 world wars, and the dot-com crash. And in the next few hours, it will no longer exist. Let's rewind, because this story doesn't start on a Monday morning. It starts when everything still looks perfect. It's early 2007. Lehman's stock just hit an all-time high of $86.18 a share. The firm reported $4.2 billion in net income on $19.3 billion in revenue. Record-breaking numbers. Bonuses are flowing. Your performance payout last December was $675,000. You're living in a high-rise in Midtown Manhattan, eating at Nobu twice a week, and your retirement account is stacked with Lehman stock. Because why wouldn't it be? The company is a rocket ship. On the trading floor, the energy is electric. Hundreds of screens flicker with green numbers. You're making markets in exchange-traded funds, managing tens of millions of dollars every single day. The pressure is insane, but the rewards are massive. You feel untouchable. The firm has been around since before the Civil War. It survived everything the world threw at it. You tell yourself that kind of legacy doesn't just disappear overnight. But here's what you don't see. Below the surface, Lehman has been gorging on subprime mortgages. The firm acquired 5 mortgage lenders between 2003 and 2004. It securitized $146 billion in mortgages in 2006 alone. By late 2007, cracks start appearing. Defaults on subprime mortgages climb to a 7-year high. The 2 Bear Stearns hedge funds blow up. Lehman eliminates 1,200 mortgage-related jobs and shuts down its BNC lending unit. But the executives keep telling everyone that the risks are well contained. So you believe them. You keep showing up. You keep trading. Then, March 2008 hits. Bear Stearns nearly collapses and gets rescued in a fire sale deal with J.P. Morgan. You watch the news hit the terminal in real time. The floor goes quiet for about 3 seconds, which, on a trading floor, feels like an eternity. Then the noise comes back. Everyone pretends it's fine. You pretend it's fine. But something shifted that day, and you can feel it in your chest every morning before the opening bell. The mortgage traders who used to sit on your floor are disappearing. Week by week, there are fewer faces. It's hard to tell if people are quitting or getting fired, but the empty chairs say enough. Your stomach tightens, but you push it down. This is Lehman. Lehman doesn't fall. June 2008. The firm announces a $2.8 billion quarterly loss, its first loss since being spun off from American Express. Leadership says they've raised $6 billion in fresh capital. They say liquidity is strong. You want to believe it. You need to believe it, because a massive chunk of your net worth is tied up in Lehman stock, and it's been sliding for months. Summer drags on. CEO Richard Fuld, the man they call the gorilla, tries to find a buyer. Korea Development Bank looks interested, then walks away. Bank of America circles, then backs off. The stock is in freefall, and your retirement account, loaded with Lehman shares that were once worth $86 each, is bleeding out in real time. September 10. The firm reports a $3.9 billion loss for the quarter, with a $5.6 billion write-down. Moody's threatens to downgrade the credit rating. Hedge fund clients are pulling out. Short-term creditors are gone. Then comes the weekend that changes everything. September 13 and 14. Treasury Secretary Hank Paulson gathers the heads of every major Wall Street bank in a room at the New York Federal Reserve. The mission is simple: save Lehman Brothers or let it die. Barclays wants to buy the firm, but the British government blocks the deal. Bank of America buys Merrill Lynch instead. There is no rescue coming. Monday morning, September 15. You walk into 745 7th Avenue for the last time. The lobby is surrounded by reporters, cameras, and satellite trucks. Inside, the building feels like a funeral home. People are crying at their desks. Some are carrying boxes. Others just sit there, staring at blank screens. At 1:45 a.m. that morning, Lehman Brothers filed for Chapter 11 bankruptcy. $639 billion in assets, $613 billion in debt. The largest bankruptcy filing in American history. And you're not just losing your job, you're losing your savings. Lehman employees collectively lost an estimated $10 billion in stock value. People who converted their entire retirement savings into company shares, people who believed in the name on the building, watched their money evaporate in weeks. You think about all those bonus checks you rolled straight back into Lehman stock. Every financial advisor at the firm told you it was the smart move. You believed them, because it was easy to believe when the stock kept climbing. Now that stock is worth pennies. Years of 80-hour weeks, the missed birthdays, the vacations you never took, all of it cashed out for almost nothing. The S&P 500 drops nearly 5% that day. Within weeks, the government lends $85 billion to AIG. The Dow eventually crashes to 6,594, down more than 50% from its highs. $18.9 trillion in household wealth gets wiped out across America. 8 million jobs vanish. The unemployment rate hits 10%. So what does this mean for you, right now, watching this in 2026? 3 brutal lessons. First, never tie your financial future to a single company. Diversification isn't boring, it's survival. Second, the people at the top don't always tell you the truth. Lehman's leadership said the risks were well contained, while the firm was leveraged 31-to-1 on toxic mortgages. Trust the numbers, not the narrative. Third, build your wealth outside the system that signs your paycheck. Emergency funds, multiple income streams, assets that you own and control. Because when the institution crumbles, the only thing left standing is what you built for yourself. Lehman Brothers didn't collapse because the people inside were stupid. It collapsed because smart people ignored the warning signs, because group think replaced critical thinking, and because an entire culture confused leverage with strength. If you found value in this video, subscribe to Frankie Finance and hit the bell so you never miss a video. Thanks for watching, and I'll see you in the next one.